A sell-off in global stocks sets equities on track for their worst week in 7 months as fears of an AI bubble return. Bitcoin tumbles amid a broad flight from risk assets. ECB President Christine Lagarde urges Europe to boost growth and says inaction on reform would be irresponsible. We'll have the details and bring you the latest European PMIs in just a moment. And Japan unveils its biggest fiscal stimulus package since COVID in a test for both the Bank of Japan and the markets. Okay, let's take a look at how some of these markets are faring this morning. We are seeing a tumble in terms of risk assets. The handover from Asia Pacific quite negative, down 1.7%, building on some of the losses from Wall Street yesterday. One of the worst weeks we've seen since the April tariff day announcement. So it has been quite a challenging week for equities across the board. But today we are seeing some stabilization coming through for U.S. equities. S&P futures pointing to open up in the green, up 0.4%. Keeping a close eye on the price action in euro this morning, slightly firmer versus the USD, up 0.1%. We have some PMI numbers that just came through, flash PMI numbers for the Eurozone, November preliminary figures showing a miss versus expectations. 49.7 for manufacturing versus 50.1 expectations. The services coming in at 53.1, so higher versus estimates of 52.8, which means that the composite as a whole, if you combine the two together, is slightly below what the market had penciled in, coming in at 52.4 versus 52.5 estimates. So a little bit of a miss for the Eurozone composite PMI. And then finally, just to wrap things up, take a look at Bitcoin. We are holding in at around 84,000, just below, down another 4% this morning. Major pullback going on in crypto alongside other risky assets as well. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning, and welcome to The Pulse. I'm Joanna Versace in Dubai. Well, stocks are poised for their worst week in 7 months as concerns over lofty valuations and AI bubble fears prompt investors to retreat from riskier assets. For more, let's bring in Van Ram, cross-asset strategist for Bloomberg MLives, keeping close track on the price action the last 24 hours. I will say, though, that U.S. equities seem to be stabilizing this morning, Van, which sort of begs the question, how much further can this sell-off go?
Morning, Joanna. It is true that what you're saying about futures, but I wouldn't read too much into them. I think what we are heading into is a period where there's going to be a heightened sense of illiquidity. What we have seen in the crypto space is liquidations colliding with a lack of liquidity, and I expect that to spill over into stocks. Many fund managers have already closed their books for the year, and it is a long weekend in Japan this week, and the next week is a holiday shortened in the US because of Thanksgiving. So, there is a bit of lack of liquidity that is haunting cryptos, and I think it'll spill over into stocks. But that aside, there is also the question about frothy valuations here, Jumana. I think when the ERP goes to zero, it is never a good idea of what it implies for returns further down the line. Whether 1 year down the line, it may be okay, but 2 and 3 years down the line, the returns certainly tend to be negative for investors. So at these levels, there needs to be a sense of caution among investors. And the investors are aware of those frothy liquidations, which is why we have seen the pullback. Well, the Nasdaq has come off from 25 to 22.5K, and I think there is further. It's going to go further towards that level, I think, as the correction deepens over the next 1 week.
Yeah, good point on the equity risk premium. It's something that we've been having conversations with EM investors as perhaps one reason for them to look overseas for investment opportunities. But I want to bring it back to the U.S. data because we did get jobs data come through, very delayed, obviously, because of the shutdown. September data, the headline figure came in better than expectations, but the unemployment rate surprised as well by moving upwards to 4.4%. What does this all mean for the Fed's upcoming December decision? It feels like investors have sort of given up on perhaps hoping that the Fed are going to cut interest rates in December.
Absolutely, Jumana. I think that, the numbers were kind of pointing to the subsequent revisions have never been good this year. And that is what yesterday's number showed as well, with a huge revision to the downside on the August numbers. But if you look at the trend in the numbers, Jumana, what we saw last year was an addition of 170K in average payrolls expansion last year. And this year, we have hardly seen 75K. So the labor market is soaring quickly, but the Fed is in a bit of a bind because they've already cut rates. Now, if you've got an economy where the inflation core PCE is still hovering around 3%, and you assume a neutral rate of 100 basis points, your benchmark can't really go much lower than 4%. So the room for accommodation is not very much. And I think that the Fed is acutely aware of that, which is why I think that they've been signaling, and we certainly saw that with the minutes that came out earlier this week, that they may hold rates next month. And if they hold rates, and I think that, the 2-year yields are going to be sticky around 350 for the time being.
Ben, always a pleasure to chat to you. Thank you for helping us make sense of some of these volatile market moves. Ben Ram, cross-asset strategist for Bloomberg MLive. Well, switching tact here, Ukrainian President Volodymyr Zelenskiy says he's agreed to work on a peace plan drafted by the U.S. and Russia and expects to talk with Donald Trump in the coming days about the proposals. Markets are reacting to the first day of new U.S. sanctions against Russian oil as Ukraine receives an official draft of the latest peace plan. Bloomberg's chief Europe correspondent Oliver Crooks joins us now. Oliver, walk us through what is exactly in these plans, because on first glance, they don't appear to be favorable at all for Ukraine.
No, Jumana, not at all. And I think that is going to be the sort of opening position. If that is for the United States, it's going to come as a massive disappointment both to the Ukrainians and to European allies when you look at what the actual content of this 28-point plan is. We've just got a copy of it. I think we're going to put it out on the terminal pretty soon. But I just want to bring some of these points out just to explain kind of what's in it for Russia, particularly on the Russian side. Point 3 here is that Russia is expected not to invade neighboring countries, and also that NATO, as a commitment, will not expand any further. Point number 7 is that the Ukrainians will enshrine in their own constitution that they will not join NATO, and that NATO, in its own statutes, will make a provision that Ukraine will never be admitted into the future. There's also point number 13, calling for the Russian reintegration into the global economy, rejoining the G8 format. There is number 21, which is dealing with territories where Crimea, Luhansk, Donetsk will all be recognized effectively de facto as Russian territory, and that the battle lines will be frozen along the other regions of Ukraine and also be recognized as Russian territory. There are provisions that reduce the size of the Ukrainian military down to 600,000 troops, which is a large reduction from the numbers of personnel that they have right now. There's also an agreement, number 8, on this plan that NATO will never station troops within Ukraine. And then number 26, Jumana, this is just sort of the cherry on top, it seems, for Russia. All parties involved in this conflict will receive full amnesty for their actions during the war and agree not to make any claims or consider any complaints in the future. Now, we should say, Jumana, this is the early draft. This is the early proposal from what the United States has submitted, apparently now to the Ukrainians, who will review this and have discussions with the Americans. But as a starting position, this is something that the Europeans and the Ukrainians will be very, very unhappy about. And we should say, Jumana, this is not just a proposal for the future peace within Ukraine. We are talking about amending the European security architecture without the Europeans even involved in these discussions.
Yeah, I mean, the point about Ukraine pledging never to join NATO also is a big one. Also, the extent of those security guarantees, if they're ceding so much territory, what's to say that we're not going to end up in a situation like this at some point in the future? Is there anything in this proposal that actually is favorable towards Ukraine?
Yeah, so I'll go through some of the points here where the sort of the things for Ukraine. I mean, the first point within the proposal, point number 1, is Ukraine's sovereignty will be confirmed. That is the end of that sentence. There is not any more greater detail on how exactly that will happen. Number 5, Ukraine will receive reliable security guarantees. Again, the sentence ends there. There is not any detail going any further. And then number 16 is Russia will enshrine in law its policy of non-aggression towards Europe and Ukraine. There are also some considerations about reconstruction and financing. But of course, for the Russians to enshrine in law a policy of non-aggression is probably not going to be worth a whole lot to the Ukrainians or the Europeans, because remember, remember, the Russians were already a party to the Budapest Memorandum back in 1994, which basically forced the Ukrainians to give up their nuclear weapons in order to get guaranteed sovereignty. And we know how that went. So again, as far as we can see from this document, there is a lot of it in here for Russia. There are a few considerations for Ukraine, though they aren't that great in volume, and they are certainly lacking emphatically on any kind of detail on how security guarantees would go going forward.
Yeah, let's see how this draft evolves with time. Bloomberg's Oliver Crook in Brussels. Thank you so much. Well, Bloomberg has learned Germany is pressing the European Union to strike a last-minute deal to let the UK access the bloc's massive defence fund before a deadline at the end of the month. The two sides are arguing over how much money the UK should pay to participate in the 150 billion euro fund. The Commission has slashed a 6.75 billion euro demand to 2 billion euros, but we're told that figure is still well above the UK's offer of a few hundred million euros. U.S. sanctions that come into effect today could leave nearly 48 million barrels of Russian crude at sea. Dozens of tankers have been scrambling for alternative destinations as Indian refiners seek replacement supplies and book oil tankers for cargoes from the Middle East. And let's take a look at some of these European key indices. We did have the PMI numbers come through, slightly weaker than expectations. The Eurozone composite coming in just a smidge below estimates. But here you can see that the risk is decidedly risk off today. So Stock 600 down 0.5%, similar amount for the DAX. The FTSE down about 0.4%. For the week as a whole, Euro Stoxx 50 is tracking losses of 3%, the worst week since April. So risk-off tone for Europe, some stabilization coming through on U.S. futures. We'll talk more about that in just a moment. Plenty more coming up. This is Bloomberg.
Wednesday. Chancellor of the Exchequer, Rachel Reeves, delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg. Context changes everything.
The conversations that matter and the insights you need. This is The Pulse. I'm Jemana Versace in Dubai. European Central Bank President Christine Lagarde has urged Europe to stop delaying measures to boost its economy and pursue deeper integration.
Europe has become more vulnerable, also due to our blatant dependency on third countries for our security and for the supply of critical raw materials. Global shocks have intensified with rising US tariffs, Russian aggression and stiffening competition from China, to name a few.
For more, we're joined by Bloomberg's economics editor, Zoe Schneiweiss. So good to see you, Zoe. Let's just recap some of the highlights from Christine Lagarde's speech just now. Obviously, a lot of focus on boosting Europe's competitiveness and growth. What were some of the main takeaways?
So Lagarde has used this venue, the European Banking Congress, time and time again in the past 6 years to tell European governments to finally get their act together and do something to make the region more competitive. She even highlights this in her speech today. She says another 6 years of inaction would be irresponsible. So she's typically used this thing just to tell Europe, you need to do something. There weren't any strong monetary policy takeaways from here. And quite honestly, when you look at the ECB right now, they generally accept that inflation has been tamed at 2%. It sounds like they're not going to do any more interest rate cuts. So it makes sense for her to go back and say, governments, we've done our part. It's now your turn to do yours.
Yeah, they seem to be pretty comfortable with where things are at. They've even said something along those lines. I'm paraphrasing vis-a-vis monetary policy. But let's turn to the data, because we got a bunch of Eurozone preliminary PMIs that came out this morning. Manufacturing seems to be disappointing to the downside. Services surprising to the upside, Zoe. What does this tell us about the health of the European economy at this point? And then also, perhaps more specifically on Germany, whether that expected fiscal boost is actually beginning to show some green shoots?
So overall, the numbers here, Germany surprised to the downside, France to the upside. France now is in a level that you could consider stagnation, which is good news for France. Germany still is in the growth area, though the numbers were less strong than anticipated. As you mentioned, manufacturing data here really disappointed. German manufacturing has been a drag for a few years now, but it was inching up to that 50 level that in PMI settings means 50 means stagnation. And they've been inching up closer and closer, and now there was a setback again in November. And that just is disappointing. Overall, regarding the whole fiscal boost that we get from those German investments, Lagarde herself acknowledged them in the speech. But one of the things we have noticed just that in Germany, everything takes awfully long. So Germany is maybe going to grow slightly this quarter, but generally that boost to growth is not expected until 2026.
Yeah, and how is this all going to show up in terms of broader European growth, the growth outlook as we head into 2026? So where are the bigger drivers going to come from? Are we likely to see another wave of fiscal loosening come through, given some of the budget constraints, especially the likes of France are facing?
So overall, governments have learned to be responsible. We just got Greek numbers yesterday. Greece is now, it looks like Greece is going to no longer have the biggest debt load by 2027. It's going to be overtaken by Italy and France. So overall, it's one of those where countries have become more responsible. At the same time, the continent knows that it needs to spend on defense. And that defense boost, as we have seen, is something that generally anchors those forecasts that the euro area economy will return to more impressive growth next year. Although overall here, Europe, and Lagarde acknowledges this, does need more on the fiscal side to actually make this sustainable.
Yeah, I mean, you look at the ECB's own GDP forecast, and they're still around 1% for next year, 1.3% for 2027. They've got to get those numbers up somehow. Zoe, always good to talk to you. Thanks so much for joining the show. Zoe Schneeweiss. Now, Bloomberg's Anna Edwards is out at the 35th Frankfurt European Banking Congress, and at 1 p.m. UK time, she sits down with Joachim Nagel, the Bundesbank president, and ECB Governing Council member. And half an hour later, she'll be joined by Nadia Calvino, president at the EIB, the European Investment Bank. And you can catch both of those interviews, those conversations rather, on Live Go on the terminal. Okay, let's go back to markets. It has been a really busy morning in markets. Let's check in with Bloomberg's Val Teitel. Lots going on, Val. I will say, you know, it struck me that the handover from Asia was so negative this morning, but yet U.S. futures seem to be stabilizing. Piece it all together for us.
Well, look, U.S. futures are stabilizing, thankfully, maybe for those equity bulls out there. NASDAQ futures are in the green. But one thing that is continuing to slide from yesterday's weakness is cryptocurrency. Bitcoin on a back foot once again, Jumana, down 4.2% just in today's session. It blew right past the 85 handle on Bitcoin and is now headed for its worst month in 3 years. Now, that is a superlative you don't hear very often. And we still have a week to go in the month of November. There are more superlatives to talk about when it comes to Bitcoin to just outline how weak the momentum has been in cryptocurrencies. There's been now 11 straight days of lower lows for Bitcoin. That is something we've actually never seen in this cryptocurrency as it continues its tumble from the October highs of around 125K. Now, the big questions here is this a tell for how the equity market is going to trade? Is Bitcoin the new barometer for risk in this recent pullback in November? Or is the NASDAQ looking at something else altogether? They did seem to slide in tandem in yesterday's nasty session where we did see the NASDAQ fall some 4%, Jumana, in an hour and 40 minutes. On the week, the NASDAQ is now shaping up to head for its worst week since April, since the Liberation Day tariff chaos back in April earlier this month. We're down 3.8% week to date on NASDAQ futures. Jumana?
Yeah, and another really good story on the terminal this morning about strategy and Michael Saylor's company and the potential exclusion from indices, what that could also mean for forced selling in that space. Val, thank you so much for breaking it down for us, Bloomberg's Valerie Teitel. Well, earlier we heard from Fed Governor Stephen Miran, who reiterated that he thinks monetary policy is very restrictive and officials should move interest rates closer to neutral. We also heard from the Fed's Anna Paulson.
I think it is incumbent upon us to move monetary policy closer to neutral levels where it's no longer exerting such restriction on the economy. Because if we don't, then that restriction on the economy itself will contribute to further cooling in the labor market that I think from these levels would be most unwelcome given the inflation outlook at hand.
Each rate cut raises the bar for the next cut. And that's because each cut brings us closer to the level where policy flips from restraining activity a bit to the place where it starts to provide a boost to activity. So I am approaching the December FOMC meeting cautiously. On the margin, I'm still a little more worried about the labor market than I am about inflation, but I expect to learn a lot between now and the December meeting.
The Fed, Stephen Miran, and Federal Reserve Bank of Philadelphia President Anna Paulson. Well, shares of French video publisher Ubisoft are up more than 5% despite being forced to restate its 2025 fiscal year accounts. The company says its auditors told it not to recognize revenue from a partnership, putting it in violation of the terms of a loan agreement. For more, we're joined by Bloomberg's Daniel Zudik, who covers the gaming industry for us. Daniel, really good to have you sort of make sense of everything that's happening with Ubisoft. It's quite a complicated story because they were supposed to report earnings, I believe, a week ago. That was pushed back. The shares were suspended last week when it was due to report the earnings. What is the company saying today?
So the company essentially said blamed the delay this morning on an accounting error. As you said, they were forced to restate their earnings. They didn't give much more detail than that, but reading between the lines, you can infer, you hear that there was a bit of back and forth behind this. You can infer that there was a bit of back and forth behind the scenes. It's certainly been another turbulent week in the history of the French games giant, but there's a lot we could probably say at this point.
Okay, so let's talk about the price action in the stock. Even before the trading suspension, the stock was down about 50% this year, about 48%. What is the catalyst for that fall? Why has it struggled so much this year?
So look, I think Ubisoft's management certainly deserves its share of blame for its recent performance. The stock, it's made a series of bad bets on games that essentially aren't suited for the current market, but the games market itself has evolved dramatically over the last 3 years. There is fatigue with the kind of AAA titles that the studio has been historically known for putting out. Both in terms of content, gamers themselves don't have the time to devote 100, 200 hours into more than 2 or 3 games a year. But there are also, how do I put this? Price as well. People are really looking to buy cheaper titles these days.
Yeah, and just quickly, just to round things up, and what do you think is actually in store for Ubisoft's future? We understand that the present is very challenging, but could there be anything that actually would constitute a tailwind for the stock?
So look, Ubisoft's underlying IP is among the strongest in the industry. It has even after the deal with Tencent earlier this year, it has titles such as Rayman, Splinter Cell, and a series of others that I won't go into now. What I think it needs to do is it needs to work out what to do with them. There is obviously always speculation around M&A, around acquisitions, but a lot of that is just chatter for the moment until we definitively know more.
Yeah, and of course there's the Tencent backing, which is an important element when it comes to Ubisoft and its future. Bloomberg's Daniel Zudik, thank you so much. A quick look at some of our key cross-assets indicators and how they're trading today. I guess some stabilization coming through for U.S. futures. Not the case with the handover from Asia Pacific. Many of those indices trading deeply in the red by the end of the close. Goolsbee down about 4%, the Nikkei down about 2% as well. That was the handover there. So the composite down 1.8%. Futures, though, are flattish. Euro up about 0.1%. And Bitcoin, as we spoke about, down 4.7%. And we will have plenty more coming up. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Jumana Bersachi in Dubai. A sell-off in global stocks sets equities on track for their worst week in 7 months as fears of an AI bubble return. Bitcoin tumbles amid a broad flight from risk assets. ECB President Christine Lagarde urges Europe to boost growth and says inaction on reform would be irresponsible. We'll have the details and bring you the latest European PMIs in a moment. And Japan unveils its biggest fiscal stimulus package since COVID, and a test for both the Bank of Japan and the markets. And we are just getting some figures from the UK. PMIs also coming through. The composite figure, a miss versus expectations, 50.5 versus the survey of 51.8. Let's delve into the details. The services number actually is the bit that surprised to the downside, coming in at 50.5 versus 52 expectations. But manufacturing surprised to the upside in the UK, 50.2 there versus estimates of 49.2. So the composite weaker than expectations. Services weaker than expectations, but manufacturing coming in higher than 50, which points to expansion on the manufacturing side of things. So this is the reaction. Not a whole lot going on with the pound, but we are very close to that 130 level versus the USD. Now, there has been a war of words between South Africa and the U.S. over the G20 summit. It's so far been marred by diplomatic dispute between the two nations over what constitutes participation in the conference.
There's things that governments can just do. And that's something that we've been pointing out. I mean, let's face it, the US accounts for only 13% of global trade. So there's 87% which is out there. What we've been telling governments to do is get on board with us and actually let's work on principles to ensure that we actually increase economic activity, not in 2 years' time, but now there's things that can be done. There are things that can be done in Africa about enabling the operation of the African Continental Free Trade Area. I think everyone knows the potential, but let's stop talking about the potential and actually let's translate that into actions now. Let's actually work to digitize the customs around borders to actually make it easy to get goods. That's called increasing economic activity. Right. And that's actually a low political risk challenge. It's just that it needs to be raised up the priority list.
Are you seeing willing engagement then from the public sector that you're speaking with?
Well, I think the critical issue here is not so much the public sector's engagement, it's the political ambition now. Governments actually have to issue clear signals to their bureaucrats to get on and do this, that it actually is an important priority, because otherwise it just gets lost. And so these sorts of things need to be activated. And frankly, one of the good things about the B20 this year in South Africa, and frankly, I know there's challenges at the G20 stream, which is obviously concerning everyone and has a lot of public attention, but the B20, which knits together the business communities from the 20 economies, is actually functioning seamlessly. And what the B20 is doing, and what I've been part of, is coming up with actionable projects to come out of this Johannesburg period, the South African period, and actually get on with enabling SMEs and business to increase economic activity. And we're doing that now.
Are you concerned, though, that that may not filter into 2026 when the U.S. takes over the presidency?
Not at all. I mean, look, if there's one thing that unites, I think, the G20, even with or without formal or physical presentation of the U.S., is the need to focus on economic growth. And you can't have economic growth without economic activity. You can't have economic activity without getting the private sector moving. So I think that's a unifying theme that will flow through. The U.S. will have different priorities, but that's perfectly appropriate.
Let's go to Johannesburg now and dig further into this with Jennifer Zabazaja, Bloomberg's chief Africa correspondent. So, Jen, I guess one of the big questions going in to this G20 is whether the U.S. were going to participate. And it became very clear earlier this week. President Trump said that they have no interest in participating. But then things sort of changed over the past 24 hours. The South African president seemed to hint that the U.S. had a change of approach. Walk us through exactly what went down and the extent of the U.S. participation.
That's right, Jumana. And really, to the surprise of many people, those comments from President Ramaphosa seemingly suggesting that potentially after months of, admission that we weren't going to see the U.S. leader actually in attendance at the G20, the fact that he was signaling potentially there is some 11th hour coordination or participation, as he put it, was quite surprising. But we did hear from Caroline Leavitt, who is the White House press secretary, countering that and saying that, in fact, there will not be a U.S. official presence. Potentially, there will be the official from the United States who will be present to actually take over the G20, because, of course, the U.S. is going to be holding the presidency for 2026. But really, it goes to show just a lot of what this G20 over the past few months has embodied, which has been quite a lot of back and forth between South Africa and the United States. Of course, President Ramaphosa went into this summit not wanting to make the supposed boycott of the U.S. be the focal point of this, but it's seeming like the war of words, if you could call it that, has only intensified. And really earlier this week, we heard from the U.S. also again threatening South Africa about putting out a joint statement at the end of this G20 summit, because they say they fundamentally oppose the theme, which is solidarity, equality, and sustainability. But still, as you were just hearing there, Jumana, from John Denton, who is the International Chamber of Commerce head, the business community, at least within this B20, seems to be unified. The question, though, is whether or not, or what, if at all, consensus we'll see from the government leaders that will be present here over the next few days.
Yeah. What are our expectations for what might actually be included in that G20 communique, Jen?
Well, what's really been the sticking point, Jumana, is a lot of that sustainability focus of the G20 theme. Climate finance has been something that has been a bit tussled with depending on which leaders you speak to. And so the question is whether or not there will be a consensus or cooperation amongst all of these countries about some of the ways in which President Ramaphosa has tried to include some of climate finance. There's also, hopefully, the expectation for President Ramaphosa, one of his priorities has been addressing debt and the high debt burden that a number of African countries, but also global South emerging market countries have focused on. It seemed like, at least from the business community that we spoke to over the past few days, there was a unification in that there needs to be a priority in some of these, alleviating emerging markets from the financing burdens that they've experienced. But whether or not, again, the U.S. will be on board is another question. I guess potentially a sign of optimism is that there are some other countries that are continuing to signal their support, including Brazil. There's also Germany. And earlier yesterday, we were with Ursula von der Leyen, of course, who was signaling the European Union support for many of these priorities. So it will be really interesting to actually see the negotiating happening and whether or not they are able to at least address some of the priorities that were very important for this first G20 summit hosted on the African continent.
Yeah, well, it sounds like it's getting very busy behind you, Jen. We'll let you go. Bloomberg's Jennifer Zabazaja, thank you so much for the reporting. All right, over to another big market story. Overnight, Japanese Prime Minister Sanae Takaichi's government has approved the largest round of extra spending since the pandemic. Funds will be deployed to address the frustrations of voters, but it's a package that may unsettle investors scrutinizing the nation's finances. Let's talk to Bloomberg's Paul Jackson in Tokyo right now. I was reading on the terminal this morning that the size of this package is about 27% bigger in terms of fiscal spend than her predecessor's package about a year ago. What do we know about the details?
Well, we're in a situation where Sanae Takaichi, the new Prime Minister of Japan, is having to balance two slightly, contradictory goals. One is keeping voters happy by giving them a show that she's doing more for them to deal with the cost of living crunch that is frustrating them so much. But at the same time, she's also got to keep investors on board, not scare them too much, not give them the idea that this is Japan's answer to Liz Truss in terms of loosening the purse strings of the nation. So in that context, she's tried to find a balance between increasing spending, ramping it up without going crazy. And I think the fact that she kept under 20 trillion yen in terms of the extra budget financing required probably means she's achieved that goal.
Yeah, well, just a reminder to viewers, we started the year off, 30-year GDP yields were at 2.3%. They're now sitting at 3.3%. So we've backed up about 100 basis points over the course of this year. And it's not the yields that are in focus, the currency as well, which has been weakening. And overnight, we heard some comments from the finance minister suggesting maybe intervention could be on the table. What do we know about that?
Yeah, the yen continues to be very, very weak. And, part of that does feed into this idea of how loose on the spending is the Prime Minister going to be, and how much is she going to try and put the brake on the Bank of Japan raising interest rates. So this has put downward pressure on the yen. And earlier this week, the Bank of Japan Governor Ueda met with Katayama, the finance minister, and nothing was really said about the currency at that point, and that gave market players a real excuse to really push on the yen. And so today we woke up first thing in the morning, the finance minister is really coming in hard with, hey, look, we will take appropriate action if needed. And that's really ramping up the volume on the warnings from about 6, very close to 10, especially when she mentioned the prospect of intervention, specifically naming that as an option that she has. Now, heading into a long holiday weekend, a timing that they've used in the past, and specifically the last time they intervened was before a holiday weekend, that really made people wake up and think, oh, maybe we're close. But if we're in 56, 57 range, you know what? I think we're okay. I think we have to get into the 58s, 158, or even to 159 before we see them move.
Well, markets love a good test, so let's see if the markets get us there in the coming hours before this long weekend kicks in. Paul Jackson, thank you so much. Well, Chicago Fed President Austin Goolsbee has signaled he's still apprehensive about delivering another rate cut at the central bank's December meeting.
We've got a series of geopolitical and policy shocks that have come in that are masking, in my view, this underlying, the economy's pretty strong, and I feel like eventually we are going to be back to rates can come down a fair amount. But in the near term, I'm a little uneasy, front loading too many rate cuts.
Let's get out to Bloomberg's Valerie Teitel again, twice on the show, Val. This time, let's talk about the Fed. It feels as though in the last couple of days, more and more policymakers on the Fed are sounding cautious about the prospect of a Fed rate cut. And indeed, that came from the minutes, too. Are we likely to see more division amongst the committee?
Look, it looks like we're headed into what could be a quite decisive meeting in December. We have the Hawks on one side digging in their heels, like you just heard there. Goolsbee saying he's just frankly not comfortable with the Fed continuing to front load rate cuts. We've heard others as well. Barr yesterday was out saying that essentially the inflation figures being above target makes him not necessarily in the camp to cut either. So we've had quite a hawkish round of Fed speak, and that does go against some pretty dovish members. We heard from Stephen Miran yesterday. I know you guys listened to that earlier in the show. He is again really forcing the case that the Fed should not just be cutting, but should be going all the way to neutral in a rapid fashion. We also heard from Lisa Cook yesterday. Now, while she didn't speak on monetary policy, Jumana, she was warning about cracks in the private credit space and warned about asset price valuations, even warned that hedge funds are getting too leveraged in U.S. Treasuries and the AI trade. So it might be setting up that Cook could be in the camp for a December cut. And that means that regardless of which way the Fed goes, we're setting up to have maybe 4 to 5 votes against a decision. Those kind of dissents, that doesn't happen very often. And this is coming at a test for Fed Chair Jerome Powell. Obviously, he's under a lot of political pressure, and his job is about to be replaced. Treasury Secretary Scott Bessent told us a few days ago that they're looking to announce the new Fed chair after this Fed decision in December, but before the Christmas holiday. So all of this really amping up. Again, yesterday, we did have that data of the September jobs release. Yes, it was a beat on the headline figure, but the market was quick to really focus on the rise in the unemployment rate. 4.4% is where we currently stand as that data from September. However, it has been a pretty steady rise in the last 3 months. We've ticked up 0.1% for 3 months running, and that is leading to some believe we might hit 4.5%, which is somewhere that a line in the sand that Powell has drawn before about where he gets quite concerned about the labor market. But again, all of this going on, we have not necessarily seen a breakout when it comes to the Treasury market, which is surprising given we've seen such substantial weakness in the equity market. We're still holding in around this 2-week level that we've been sitting in on the front end. Policy sensitive 2-year yields trading at 352 today. A lot of discussion again about that December meeting, but it's not necessarily leading to a decent rally or sell-off in the Treasury market. Jumana?
Yeah, my favorite terminal function, Val, WIRP, what's priced in for the Fed? Only 7 basis points now for the December meeting. So let's see if that changes. Thank you so much for the recap. Well, coming up, as UK consumer confidence dips, restaurant chain Hawksmoor says their festive bookings have hit record highs. We'll talk to the CEO next. This is Bloomberg. The conversations that matter and the insights you need. This is The Pulse. I'm Jumana Versace in Dubai. OpenAI is partnering with Taiwan's Foxconn to design and manufacture hardware for data centers. It makes the latest move by OpenAI to meet its growing need for infrastructure to support AI systems.
To keep pushing the frontier, we need to build these new types of AI infrastructure hardware at scale. And I'm excited for that to happen in the US and with Foxconn. Foxconn's experience building complex infrastructure and hardware at massive scale makes them the ideal partner for this, and I'm looking forward to exploring together what this can look like. We'll share insight into emerging hardware needs across the AI industry, and Foxconn will use that to design and prototype new equipment that can be manufactured in America.
It also reflects Foxconn's broader push into automation and advanced AI. Foxconn's chairman, Young Yu, spoke to Bloomberg's Annabelle Drewlers about stepping up the company's global AI ambitions.
The gigawatt per week will be the goal.
Okay, 1 gigawatt per week.
Per week. That will be same goal. Okay. But we can start with 1 gigawatt per month.
So you think you can add 1 gigawatt per month next year?
Starting the second half of the year.
Second half of the year, so you think you can add 6 gigawatts next year?
I'm not sure. It really depends on our study and our new way of doing things. It takes time, but eventually we're going to get there.
Let's talk about then this opportunity in the US, because as you said, part of this is about Make in America. It's very ambitious. What's the capex that you need to also dedicate to the States?
The capex-wise, it's in maybe 1 to 5 billion to start with, to build the factories, to build R&D centers, but to build the working capital required to build a data center. That's totally different. That requires huge amount of money.
Yeah.
And with that, we are going to work with SoftBank.
What are the biggest challenges with scaling up in the US?
Shortage of labor. As I mentioned to you, it's not the labor cost, it's a shortage of labor.
How do you get around that? What are the conversations like, and what are the biggest shortfalls that you see?
Yeah, we had to work closely with schools and the government, which we were very familiar with when we build factories all over the world. We had to work with local agencies or local government to get their people ready for the kind of job that we require.
That was Foxconn Chairman Young Liu speaking to Bloomberg TV's Annabelle Jewelers. Well, a closely watched index of consumer confidence in the UK has fallen on every measure. Research company GfK says its overall confidence level fell 2 points in November to minus 19. This comes with UK Chancellor Rachel Reeves expected to unveil a range of tax hikes on November the 26th. So UK consumer confidence may be slipping ahead of next week's budget, but restaurant chain Hawksmoor says it's bucking the trend. It's reporting a record £100 million a year, despite being forced to navigate the soaring cost of beef. They say they're up 16% on early Christmas bookings in the UK and Ireland, and 65% in the US. Tomorrow, the steakhouse group's newest St. Pancras restaurant will open its doors in London as well. Really happy to say that joining us now is Will Beckett, CEO and co-founder of Hawksmoor. Really good to have you with us on the show. It's about lunchtime over here in Dubai, so my mind is wandering. I'm thinking of food now. Let me start off just asking you, the backdrop. We think about steaks and cocktails. Yeah, the UK confidence figures have not been so supportive. Still very negative, minus 19. How is that showing up in the hospitality industry?
Yeah,
Food and hospitality.
I think you said the right thing, the trend and bucking the trend. I think that the trend generally in the UK is down. Consumers are a bit nervous. Restaurant chains, for example, are struggling a little bit, but then there are a small number of businesses, and we're very happy that Hawksmoor is one of them, that are bucking the trend. And so we find ourselves very busy, even busier than usual this year, and we're still in growth mode.
Yeah, and how are your holiday bookings shaping up to be? Obviously, you do have the opening of your new restaurant in St. Pancras tomorrow. What's the outlook for the coming season?
Yeah, I checked that the end of last week actually, and we had about 60,000 people already booked in for the run up to Christmas in all of our UK restaurants. The new restaurant opens on Saturday, and we've already got an additional 6,000 people booked in there. So that's a step up for us. People are booking earlier in greater numbers. I think we're about 16% up on where we would have been about last year.
Yeah. Next week is going to be a big one for the UK economy with the UK budget. What are you watching out for? How is it likely to affect your business?
I mean, I think it'll affect it in all sorts of ways, really. I mean, taxation, consumer confidence, however they kind of treat labour, what changes are made there in terms of minimum wage, all that sort of thing. I generally think it is our job just to react to the circumstances that we are given. And I think probably Hawksmoor's record of doing that since COVID is really, really good. But yeah, I'm not sure that there's going to be anything in there particularly that is a really good news signal for the hospitality industry.
Okay, and despite that, you remain confident about your own business. One of the other headwinds that you've had to deal with is simply rising beef prices. How have you managed to navigate that? Have you passed on those prices to consumers, or have you absorbed that in your margins?
Well, we haven't absorbed it in the margin. We've passed on a small amount, an kind of inflationary rise to consumers. But actually, for the most part, we have either protected ourselves from it because we've got a very, very strong, long-standing kind of set of supply chain relationships that really, really helps protect us against the worst moments, where we work with farmers in the UK, in Ireland, in the US for the best kind of long-term interests of everyone. But also we've worked really, really hard on procurement on the cost side, just to make sure that we are running our business as efficiently as possible. So actually, during that period of very high inflation in the UK and increasingly very high inflation in the US, we've managed to improve margin without massively changing costs at all for consumers.
Okay, one final quick one for me. A couple of years ago, meat substitutes were all the rage. You had all of these companies benefit from the move away from meat, and you've seen the rise and fall in the share prices of those companies. Today, would you say that meat is firmly back on the table again for consumers?
Yeah, I think that's true. I mean, there was all sorts of conversations, let's say 5 years ago, about the rise of veganism, about alternative meats. And for us, we approach that really in terms of sustainability. We're a B Corp. We wanted to make sure that everything we do has the kind of planet and future in mind. But as you say, kind of meat is back on the menu, I think, much more broadly. For Hawksmoor, it never really went away, but people are very interested in protein now. They're interested in where they get their meat from, and that's great for us.
Yeah. Well, back on the menu, giving me lunch ideas over here in Dubai. Well, Beckett, thank you so much. CEO and co-founder of Hawksmoor. I'm going to leave you with a picture of U.S. futures. Things are stabilizing ahead of the open and picking up off a very risk-off session from Asia. Up next, Bloomberg Brief. This is Bloomberg.